Hey y'all. Happy Sunday.
Happy Sunday.
Does anybody know what
Hey.
time Super Bowl starts?
I think 7:30.
Oh, okay.
I think. I could be wrong.
No, it starts at 6:30.
There we go. I know where something's 30.
Yep.
Okay. All right. So we should be good. We should be good. Okay. So today's masterclass is going to be the Options Masterclass. And this was by request last week. So we're going to go ahead and go over it. I will let you guys know that I have been super, super busy with this futures course. So this is probably going to be the last options related masterclass that I do for a little while because I really want to focus on the futures. Um, but this is going to be for the people that, want to add options to their investment portfolio and start playing around with options. This is for complete beginners that don't know how they work, why you want to use them, how they benefit you, and all of that. As of right now, I've been swinging options. That's been the best and most kind of passive way for me to trade options right now. I'm not scalping options unless futures has issues, which it has been having a lot of issues in the futures platform industry lately. But as long as futures is up and running, I'm scalping futures because the price action, not having to worry about the Greeks, is really beneficial when you're just doing these quick profits and in and out. But we'll get into all of that. So let me go ahead and share my screen. I'm like at this co-working space, but the lighting is so bad. 1 second. All right, you guys should be able to see me and the Options Masterclass in the background. All right, so this is going to be the Options Masterclass presented by me. Today's date, February 8th, 2026. So all updated information and my website down there for you guys that don't know. This is going on YouTube also. All right, so options trading for beginners. What are stock options? First and foremost, what are stock options? So options are contracts, not shares.
Recording your progress.
Hold on, someone's mic is on. Okay, so options are contracts, not shares. They give you the right, but not the obligation to buy or sell a stock. That's the jargon behind it. We're never holding options to the point where we're exercising it and we're actually buying the shares that are in these contracts. We're just trading the contracts for the price. So we don't really have to worry about that. But the contracts are set at a specific price and they have to be executed, bought, sold by a specific date. They have expiration dates on them. All options contracts do. So a big distinction is we're trading a derivative, not the actual stock itself, but the contract moves its value based off of the underlying stock that it is. So what an options contract controls is one contract of an option is 100 shares. That's what it's controlling in the market. But we're not owning the shares, we're not invested in the shares, we just have the contract. It's a little confusing, but yeah, because shares have no expiration date. That's why you like shareholder, part ownership in the company. Contracts, we're not part ownership in the company. We're not going to be getting dividends on it, nothing like that. So small price moves equals big percentage swings because it's essentially moving like 100 shares in the market. And that's where the leverage comes from. So it is important to know that leverage amplifies the wins and the losses. We love leverage. We love a contract moving that much when it's going in our favor, but when it's not, we can also see how that could be risky. But before we get any further, we need to know, just in case people are brand new, the stock options trading hours are the same hours as the regular New York Stock Exchange. So Monday through Friday, 9:30 a.m. to 4 p.m. Now, when it comes to options, it is a hard cutoff at 4 p.m. I believe that there are a couple options like SPX and the big ones like that that'll allow you to sell it at 4 up to 4:15 p.m. But I could be wrong, but I could have sworn that I did that before. So a couple of them they have it goes to 4:15, but it's also going to depend on your broker. And a lot of stock shares nowadays are 24-hour markets. You can actually buy into them at any time, but not with options. Options you can only buy and sell them 9:30 a.m. to 4 p.m. A little bit more about the options versus the stock shares. With the stock shares, you own the price movement because you're a shareholder. There's no expiration. It's simpler psychology because there's no Greeks involved. If the share is trading at 2 cents above where you got in at, you're in profit. It's very simple price action. It's slower because stock shares move slower, but it's also more forgiving. You don't have to be super precise with your entries when it comes to stock shares because you're not going to be in crazy drawdown if you get an imperfect entry, unlike with options. With options, you are essentially profiting off of the direction, the timing, and the speed. So basically, the faster that an option contract goes in your direction, the more money you will make. It's all about speed. And so that's why you'll see sometimes these 0 DTEs, 1 DTEs, which means 0 days to expire or 1 day to expire. You'll see them go up like 400%, 500% in minutes. It's because the move happened so fast, and it's usually puts, because as I like to say, the market takes the stairs up and the elevator down. So we can like grind higher for like, all day, and then one sell candle will wipe out all the day's profit. But if somebody had a put, which is an option that makes money when the stock goes down, they would make so much money on that put option in that little 5 minute, 15-minute candle because it happened so fast in the direction that need to go in. So it's all about speed when it comes to the options. You'll see these contracts just jump up because of that. So it's faster, it's riskier, and it's also emotionally intense because of that. So you feel like you need to get the perfect entry because literally every minute counts when it comes to the options. And back to that about every minute counting, sometimes you'll even see that, wow, if I would have just waited until the end of day to buy this exact same contract, I could have saved 20%. Like you'll see a contract go from $200 to at the beginning of the day, and then that same contract go to $150 at the end of the day, even though the price didn't move that much. Maybe it was a consolidation day where price was just kind of sideways or opened and closed around the same price. The option contract lost value, lost money because of theta decay, because of time. You could have saved money on buying that option if you just would have waited until the end of the day to buy it. So it's so time sensitive, and that really contributes to like how intense it is because it's so time sensitive. Now, more on the shares versus options, it would be like, okay, I just mentioned a lot of things that could be seen as cons, right? So why do people even bother with options? What's the difference between buying shares of the company and just being patient and making money that way versus buying options of the company? Well, the big reason why a lot of people buy options is because it's cheaper. It's cheaper to buy options of the company than buy shares of the company. And you make more money. So it's cheaper and you make more. So those two things tend to outweigh the cons for a lot of people. For example, and I just took the same thing, um, screenshots and everything from my Options University course because it still stands, but keep in mind, Tesla is not this price anymore. So that's going to be the difference here. But regardless of the stock, here's an example of how the price would work, the price difference. So let's say Tesla is currently trading at $307.17, like in the screenshot. If you wanted to get 100 shares of Tesla, which is what you would need to get in order for it to move like one contract of an option, you need to get 100 shares. If you want to get 100 shares of Tesla, that would cost you 100 times $307, which is $30,717. Okay, that's a lot of money to get 100 shares of Tesla. Now, if you wanted to have the same type of volatility, not volatility, what's the word? The same profit outcome or a similar profit outcome of 100 shares of Tesla, you would get one in the money contract of Tesla. Well, one in the money contract of Tesla, and this, mind you, this is very deep in the money, very, very deep in the money, meaning it has intrinsic value built in. I'll get into what intrinsic value means, but it has a lot of that built in because essentially this is the price of a $255 call. So that means that as long as Tesla stays above $255, this is essentially in profit. As long as the expiration date's not too close. The Greeks really come into that, but that's the gist of it. And so with the share price being $307, this is way in the money. This is considered a very good quality option, so it's more expensive. So a very good quality expires weeks later, deep in the money contract, which is very expensive. Still, one of the most expensive contracts you can get is $5,835. Way less than buying 100 shares. So you can get a superb quality option for a fraction of the price of buying 100 shares. So that's why people go the options route, because it's cheaper. Now, here is some terminology you're going to need to know, and then also how you can profit off of a call and a put option. So with options, there's calls versus puts. A call option simply is our version of buy, okay? And a put option is our version of sell. You get a call option when the price is going up or when you expect the price to go up. You get a put option when the price is going down or you expect to go down soon in the future. Because again, this is time sensitive, so we want these things to be happening sooner, not later. Okay, but put option down, call option up. That's it. That's the gist. Now here, let's say that you were to buy a call option of stock XYZ, any stock, any ticker symbol, XYZ, $40.5 is the strike price. Whenever you see in the option, on the options chain, the option contract name, the number with the dollar sign is the strike price. And we'll get into what strike price means, but that's the strike price. So $40.5 strike price with an expiration date of 12/23. Let's say you bought that call option for $200. And 2 weeks later, the XYZ stock price went from $40 per share to $42 per share. So to close this option and exit the trade, you now need to sell that call option. So you need to sell it back to the market for someone else to buy it. When you sell that call option, now that call option is worth $300. So you sold it back to the market for $300 and it went up $100. because the stock price went up. So you made $100 off of this call option. Now, on the other side of things with a put, if you were to buy a put option of XYZ, $150 strike price, that expires 10/31. Let's say you bought that put for $105. And 1 week later, the stock price went from $160 per share to $155 per share. So it went down $5. To close the option and exit the trade, you need to sell the put back to the market. So regardless if it's a call or a put, you're buying the option to get it and you're selling it back to get rid of it. So we sell the put option, same option, XYZ, $150 strike price, 10/31, for $220 because that's now what it's worth. So the difference between $220 and $105, what you bought it for, is $115. So you made $115 off of this put option. That's how you make money. You make money off of the difference between what you bought it and sold it for. The contract itself, not the underlying stock price, but the actual contract itself. What is the break even? What do you mean the break even?
Where it says like they're under 255 call and it says break even, then
Oh,
313. What that mean?
okay. So this is screenshots from Robinhood. And Robinhood, it's so weird, y'all. I honestly ignore this. It's so weird because Robinhood will try to like guesstimate where, if like worst case scenario, what's your break even price would be, but it's always wrong. Like you could be way in profit and it's like nowhere near break even. So this is just like their guesstimate of like what the underlying stock share price needs to be for you to break even on your contract, but it's really, 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 really off. So just kind of ignore that. And that's just a Robinhood thing. You're not going to see that on a lot of different brokers. And then the percentage to break even is telling you what percentage away the current share price is to this break even price. So 313 is 1.79% away from where it currently is. It's just their like guesstimate, but it's really off. Okay, so here's another screenshot of like what an options chain will look like. In every platform, the options chain is going to look a little bit different. And so that's the thing. When you're trading options, you're going to want to find a platform and a brokerage that you like, and you're going to want to stick with it because trying to learn even the look of the options chain on different brokers can vary very differently. Like the options chain on Robinhood looks like this, and then we can go to Webull and see it look completely different. But the numbers are going to be the same. The strike price, the expiration date, the premium price, which is the price you pay, all that should be the same across the platforms, but everything else pretty much looks different. So let's talk about the strike price. That's what's circled right here. So like I said, on any options chain, the number usually is right in front of the word call or put, but sometimes it's after the word call or put. The number with the dollar sign is the strike price. And the strike price is the price that you would pay if you were to exercise your rights on an option. Meaning, if you were to not sell the option back to the market and you were to, it's called exercising, where you're saying, okay, I actually do want to buy 100 shares of XYZ at this set price. Exercising doesn't really have a lot of benefits, so we don't really do that. But that's essentially kind of why options was created, was for investors to buy a boatload of shares at a cheaper price or a preset price. But now that they've added in all the different stuff, it's not really beneficial to exercise. But that's where the strike price is coming from. That's the price you would pay if you did decide to buy 100 shares of the stock. So that's the agreed price in the contract. That's not where you enter the trade, and that's not where you exit the trade. That's just the agreed price in the contract. So the further away that the current share price is from the strike price of the option that you choose, the more out the money it is. Okay, so we'll get into out the money, in the money, and at the money, but just know the further out you go away from the share price, the more out the money it is, and the cheaper it's going to be. But it's cheap for a reason. It's cheap for a reason. The closer you can get to the actual share price, the better that option is going to move and the more money you're going to make on it. So why doesn't everybody do it? Because it's expensive. Like if you were to get a $280 strike price call, it would be very, very expensive, even more expensive than what this is showing. But you would make more on it. So there's pros and cons. But most people can't afford the at the money strike prices. So you just kind of go out to what you can afford or what you are whatever your risk tolerance is, because also the out the money strike prices, they come with some crazy volatility with the Greeks. And so you can actually make a good amount of money on some out the money options if the move happens very fast. But if you buy an out the money option and you sit on it, Theta, which is time decay, will eat all the profit up. So sitting on out the money options is not good. But if like we're having a you know how we've been having like those sell-off days recently in the market where just things just look like it's falling off a cliff, you could buy out the money option and it'll be up and it's fine because the move is happening at that current moment and it's happening fast. But if you were to get a longer dated out the money option and sat on it for a couple weeks, by the time it could be in the share price could be, well beyond what the strike price is, which essentially should mean you're in the money, but because it was out the money when you got it, you would lose money still. So here's the screen I was talking about. So this is in the money, at the money, out the money. These are terms that you're going to hear pretty much only with options. I haven't really heard these terms anywhere else. And this is all based off of the strike price that you choose. The strike price you choose is going to be often referred to as, you also hear it, with the acronyms ITM, ATM, or OTM. So let's talk about in the money. No, actually, let's talk about at the money first. If the options contract strike price is the same as the stock price, so if I get an Amazon call, if I get a $260 Amazon call and Amazon is currently trading at $261, that is at the money. That's at the money. The same rule applies with both call input options. If it's in that same range, if it's in between, what the other options are, because a lot of options, they move or they have the strike price every $5 or sometimes every $1, depending on the expiration date. But you'll see on the options chain, if if the strike price is touching the current share price, the midpoint, that's at the money. And the pro of an at the money contract is the likelihood of it getting in profit is very high because it's right there. It's right there at the money. The con is it's a costly premium. Costly premium. Why does it say likelihood of staying out of profit is high? I don't think that should be there, y'all. No, that should not be there. Let's talk about in the money. In the money. A call option is in the money if the stock price is higher than the strike price. So what does that mean? A call option makes money when the price is going up. So that means that it's in the money if the stock price is currently higher than the strike price. So with a $260 Amazon call option, an in the money contract would be $250 strike price. It's already $10 in the money. Essentially, when you buy some of these like in the money contracts or even deep in the money contracts, you'll notice as soon as you click buy, you're already up like 5%. They're essentially already in profit. So on the other hand, with a put option, when a put option is in the money, if the stock price is less than the strike price, then that's in the money for a put because it needs to be below for you to profit. So the pro is you're pretty much instantly in profit after buying it, and the likelihood of staying in profit is high as long as the volatility isn't crazy on it, on the actual stock. But the con is that it's a very expensive premium. It costs to be in profit like that. Very, very, very expensive premium. Now, out the money. This is what people get caught up with, and it can become gambling real quick. Real quick. So, out the money, if a contract is out the money, then it does not have any intrinsic value. Essentially, it's worthless unless unless the stock price goes towards the strike price of the out the money strike price soon, immediately, quickly, swiftly. A call option is out the money if the stock price is lower than the strike price. And on the other hand, a put option is out the money if the stock price is more than the strike price. The more out the money you go, the less likely you are to profit off of that option. Slightly out the money is fine because if you know or assume or are banking on based on your charting and all that, okay, Amazon's currently at 260, but it's looking like it's going to hit this area at 269 by next week. If you were to get a $270 strike price that expires in 2 weeks, that's technically out the money, but you'll be a little bit in profit, not as much as you were if you would have gotten it at the money or in the money, but you would be a little bit in profit because by the time it gets there, you would be at the money. As long as it's not too close to the expiration date. That's the thing. That Theta will ruin everything. So the short dated contracts are so risky because everything could be in your favor. The move happened when it needed to happen. It went to the price it needed to go to. And if it took too long, Theta is going to literally move the contract to 1 cent, which is worthless. So, yeah. Now, the premium is the price you pay for the option. On Robinhood, it looks like this. This is the premium price. And now on any platform, the premium price is going to be the price per share. I don't know why they do this, but the premium price is going to look like the price per share. So you have to times it by 100. So this call option doesn't cost $16.84. It costs $1,684 because you got to times it by 100 or move the decimal point over 2 places to the right. It would be so much easier if they just did that already. But yeah. So the price that you see before you start paying for it, you got to move the decimal place over 2 places to the right. Or multiply by 100. So when you buy an option, you pay this premium. And then when you sell this option, when you sell it back to the market, you'll receive a premium. So the difference between that is your profit or loss. Expiration dates. We've been talking about expiration dates a lot because it's so important to whether you're going to profit at all. An expiration date is the last day that an options contract is valid. So you'll hear terms like weeklies, monthlies, and then long dated options like swings, leaps. But basically, a weekly option is something that expires within the week, monthly, within the month, long dated, usually 3 months or more. A leap is technically supposed to be 1 year or more. And so I personally like leaps, and it's going to sound bad, but I'm kind of hoping for a market crash so that we can get to a point where we can get some leaps and just like hold it for the rest of 2026 or whatever. Because that's like the easiest way to trade options is when the market has crashed and it's a bottom and blah, blah, blah. Getting a leap, it could just be one little leap and just sitting on that for a couple months. That's my favorite way to trade options. But we're not in a swingers market right now. We're not in a leap buying option right now. It's too volatile. Right now, we're in a scalpers market. So the thing is with the expiration dates, the further out you can go, the better. But the further out you go, the more expensive it's going to be. Even if it's out the money, doesn't matter what it is. The further out you go with the expiration date, the more expensive it's going to be for the premium. Now, you'll see a lot of people trading the 0 DTEs, 1 DTE, 2 DTEs. They're risky. They're really, really risky, but they're so, so tempting because they're so cheap. They're so cheap. You can get a short dated expiration contract for $10, $20, $30. And the thing about those is if you're going to trade those, you really need to see profit, take profit. Because when those short dated expiration contracts go into profit, they don't stay in profit for long. As quickly as they got in profit, they can go out of profit because the volatility in the IB is so high on those short dated contracts. And the theta moves so crazy because it's about to expire. So the clock is literally working against you with them. One thing also is never swing 1 DTE. You can wake up the next day and the stock moved up $20 and that contract is worthless just because it expires the same day. And it would like really make you mad because it's like, what happened? I'm supposed to be in profit. Well, if you would have got a at the money or an in the money or a longer dated contract, it would have been in profit. The four things that affect the options prices: the stock price movement, the underlying stock price movement, the time. So time dependent, so time sensitive. Volatility, and the ultimate demand. Now, I was trading options exclusively. I didn't trade nothing else. I didn't trade forex, didn't trade nothing else for a good 2 years where it was just exclusive options, maybe even 2.5 years. And I noticed some things. And so when they say the options prices depend on these four things, the demand thing, I noticed that in real time. I will literally, because I'll add options to my watch list to either buy later or literally watch how it moves to, get practice and stuff like that. And I would see the thing about options, I feel like the more I'm talking about options, the more like risky and like not worth it sounds. But the thing about the options market is whoever's the contract writers, they can like change the price like at any time. So, and it can go off of demand. So I've seen like the new contracts that come out, the new ones that come out. I've seen them put options on the market. Let's say a stock has a lot of buzz or a lot of hype in the news. They'll put options out on the market that's like 3 times what it was, what that same type of option for that same stock was last week, just because now it has buzz. So you're paying 3 times as much for the premium for no reason. No reason. So the demand of it really does um matter. And then also another way to see demand is open interest. So there's when you click on these option contracts, you'll see all these numbers. And one thing you'll see is open interest. The higher the open interest, the more people are trading that particular and specific contract. Typically, you want to go with trading contracts that have a lot of open interest because you know that um it's going to get your orders are going to get filled right away and there's not going to be any slippage, and knowing that there's demand in it is good because it's also like monkey see, monkey do type of thing where, okay, if 20,000 people are trading this option, this must be a pretty good option type of thing. So there's that. And then the options writers know that. So if there's a lot of open interest, they'll like inflate the price. It's crazy. So yeah, that's what they mean by demand. Now, and you'll also see that around earnings season too. And all of it, and as far as like inflating the price, it's all written in there in a mathematical way because the contracts are based off of formulas. The pricing is based off of formulas. So like they just may like increase the IV or something to make the price be inflated for the premium, but it's based on demand. Like you'll see if a stock has earnings coming up, if you were to try to get an option the week of earnings, it would be like 3 times as much what it was last week or the week after. Now, those are like some of the cons, right? But there are pros of trading options, and sometimes, especially like if you can get some in the money options, and it's just like, okay, as soon as I click buy, I'm in profit. It could feel like, okay, this is like I've found the sweet spot. I know what the strike price is. I just keep rinsing and repeating the same thing, and it can feel so profitable because it's like I'm taking this small amount of capital. I get these large percentage swings based off of fast movement. And like as long as you are good with that type of dance that you have to do with it, options is super profitable. Super profitable. Don't get greedy, see profit, take profit, all that, rinse and repeat, buy it again the next day. Like buy support, sell at resistance, buy or buy a put at resistance, sell a put at support. If you can get into the groove, it can feel like, okay, this is like really profitable and flipping I'm flipping a small amount of money into a big amount of money. I've seen the most intense, I guess, or the fastest account flips with options in forex I've seen because it doesn't take a lot of money to make a lot of money. So let's talk about the Greeks. I've been foreshadowing them for a minute. Options Greeks are mathematical risk measuring metrics that quantify how an options price changes based on specific factors like the underlying stock price, time to expiration, and implied volatility. That is Google's explanation of the Greeks. The primary Greeks are delta, gamma, theta, vega, and rho. And all these help investors manage risk and predict potential price movements. All of the Greeks are baked in to the price of the contract. It's all baked in. So you won't ever have to do any of this math. This is Robinhood. This is me pulling up a Amazon $215 strike price call option that expires February 18th. And you'll see all these numbers here. And then on Robinhood, it says the Greeks, and then it'll say delta, gamma, theta, vega, rho. I didn't get a screenshot of those pictures. I think it's on the next screen. Essentially, these all mean different things about how the stock option is going to move. It's all about how it's going to move. Okay, so, and then up here, this is IV, this is implied volatility. The lower the IV, well, that's not always true. I was gonna say the lower the IV, the better. But sometimes you want a kind of high IV because you know that it's about to move. But then also like you can get IV crushed. It's a lot. I'm not going to get into that. Okay. And then this is the open interest I was talking about. So this contract actually doesn't have a lot of open interest at all. And then this is, especially for Amazon, this is the chance of profit. This is Robinhood's estimate. This is about as useful as the break-even estimate on Robinhood. They're trying, but they're missing the mark on this. Um, Now, when it comes to the Greeks specifically, we're just going to talk about these three. Delta is how much the option moves with the stock. Theta is time decay, which is your enemy. As option buyers, that's our enemy. Option sellers, if you sell options, that's your best friend. But we don't sell options because to sell an option, you have to have 100 shares of the actual stock in your portfolio. Vega is the volatility changes. Okay. Delta, some people are delta chasers. And so what delta means is this is how much the option moves with the stock. So basically this means that for this option, which is literally this one, no, it's a different one. This is a different Amazon contract though. This means that every dollar Amazon moves, the contract is going to move 49 cents. But keep in mind, this is per share of the contract, so you have to multiply it by 100. So technically, for your premium for your contract, every dollar that Amazon moves, this contract is going to move $50. So you're going to profit $50 on every dollar Amazon moves in your favor. On the opposite end, if Amazon, let's say this is a call, if Amazon goes down $1, the contract is going to go down $50. Okay. So some people they get really, really, really into delta and they'll like literally look for the contracts that have the highest delta because then that means that the stock doesn't have to move that much for them to make a lot on the contract. But if it's against you, then you lose a lot on the contract. Now, theta is always going to be a negative number because it's decay. This means how much the option is losing per day, regardless of anything. And this increases as time goes on. This is the starting decay. And then it's kind of like a graph, an exponential graph that goes up closer to the expiration date. So on day one, this contract lost 15 cents. This option lost 15 cents off rip. So no matter what, this is going down 15 cents, which we got to move it. The decimal place, 2 places to the right. Off rip, day one, this thing is losing $15. Your premium is down $15. Now you can outweigh that, but whatever you make on that contract, day one, you lost $15. Day two, this theta. Okay, so Vega. Okay. I want to look this up right now, but I don't want to get off of the screen. If someone knows, put it in the comments. One of these is either Vega or Rho. I think it's Vega. But one of these actually tells you how much theta is increasing per day. For instance, It starts off losing $15 a day, and then the next day it's going to be, let's say it was the Vega number, 3 cents, which is $3 for the premium because it's times 100. So then that means the next day you got to add 3 cents to this. So the next day it's going to lose $18 that day. And the next day it's going to lose $21. And the next day it's going to lose $24 and just $3, $3. So if you want to like nerd out with it, you can really like, learn about it, but it's intense, but it's all right there. It's literally none of this is hidden. It's all right there. So you know how much you're going to be losing per day. So people be shocked, but it's like it's right there. It's right there. So obviously, the lower the theta, the better. And guess what comes with a low theta? Long dated expirations. They come with a low theta, and deep in the money contracts come with a low theta. High theta, soon to expire, out the money. High theta. You're losing a lot per day, no matter what. Doesn't matter what the stock did. It's minus 15 on top of whatever you made or lost. It's literally like, I don't know, like an analogy for it. It'll come to me. But yeah, Theta is not that girl. Google says Vega. Okay. Yeah, I thought it was Vega because Vega is the volatility one. So yeah, if you want to know how much your theta is increasing per day, then you look at Vega. Theta is just the day one decay. And then you gotta add Vega on top of that every day, compounding, compounding, compounding until the contract reaches zero. Why time decay hurts beginners? Because options lose value every single day, regardless of what you do. And it speeds up the faster you get to expiration date. And so waiting is punished. Sitting on something and waiting until it expires is never going to be a good outcome. So yeah, it may feel like options are rigged, but again, the Vega, the Theta, all that stuff is right there for you to see. So it's not rigged, it's just really, really time sensitive. And you will see that these option contracts lose value so fast the sooner you get to it expiring. This is an iron call that expires that week. And you can see the last week of its life, essentially, the last week of this option's life, it lost 90%. Even though this strike price is not too far away from the actual stock price, but it still lost 90%. That's that Theta. Okay, so this screen here is also taken from Options University. This is how you can this is for the people that really want to know the numbers behind everything. But all this math is done for you automatically. Okay, so basically, let's say I paid, and this is the real screenshot, I paid $2,670, $26.70 premium. Average cost, that's how much I paid for it, but you got to move the decimal place over for this Amazon call option on September 6th. And I sold it for $2,933, represented right here by the current price. Well, actually, right here. So the current price of the contract and the market value, this is where the decimal place is moved over and it shows you the actual premium and how much it's worth in the market. This is how much the contract is, but again, it's the decimal place isn't moved. So selling it back to the market value is $2,933 on September 9th. So 3 days later. But that was 98 days away from my expiration date. So I was able to make good profit on it without Theta or anything eating too much into it because it's still really far away from the expiration date, and I didn't hold it that long. I only held it for 3 days. So the profit is the difference between the current market value and the price you paid, which is $263. This is how they calculate IV, implied volatility. Implied volatility is the current share price minus the strike price. So like I said, all of these numbers, they all come from formulas, and it's all right there. So the IV is the current share price, which is $129, the share price down here, $129.51 minus the strike price, 104, equals the IV, implied volatility. Oh, sorry. This is intrinsic value, not implied volatility. Intrinsic value is 25.51. And then to get the extrinsic value, you would take the premium paid minus the intrinsic value. But we had to do the IB. We had to figure that out first before we can subtract that from the premium, which is 26.70. That's how much it costs, the premium, minus 25.51, which is the intrinsic value, means that extrinsic value is 1.19. That's how they get the profit. So the profit is the current premium minus the intrinsic value multiplied. Is this multiplied? No, minus the extrinsic value. But you got to do this one first, so it's in parentheses, which is essentially the current price of the contract minus the intrinsic value minus the extrinsic value. All these numbers get 2.63 times 100, $263. So that's how they get the profit. You gotta like work backwards, but that's how the profit is calculated on every options contract. Again, you'll never have to do the math like this. And that's why I took this screenshot and put it in this masterclass, because I'm like, I'm not about to do this math again. That's a lot of math. Okay. But that's how they get the price. It's not like some random thing. It's all baked into these numbers in the contract. So here's why options traders lose money. Buying too close to the expiration date and sitting on it. I'm telling you, if you're going to get a short dated expiration, the move needs to be happening immediately. Immediately. Trust me, I've learned my lesson on this. Over leveraging, okay, that's going to get you anytime in any market, but the options market for sure. Holding too long, options traders do not benefit off of holding and sitting on options unless it's a leap, because it's so far out. The theta is so low, it's fine. But also with leaps too, let's say you get a leap that's 12 months out. Once you get 6 months away from the expiration date, you need to start looking at closing it, because that theta is going to start picking up and you're going to start making less money on these moves. So it would be kind of pointless to hold it anyways. It gets to a point like that, especially if you get in like a season of consolidation where you're essentially just paying to hold it. You're paying a price every day, which is the theta, just to hold it. So if we're consolidating, you don't want to hold these options because you're just literally just losing money. Options only make money when the price goes significantly up or significantly down. Any time of consolidation drains your options. You do not want to be trading options when we are in periods of consolidation. That's a day to sit out. Oh, the market's consolidating. Not even going to bother. You're going to be trying to outrace Theta and just like hoping like you're going to be spending all day to make 5%. You could do that in shares by buying and holding shares and not having to like stress and buy and sell a bunch of things. So consolidation, not the time to trade options. Not understanding the Greeks is why options traders will lose money because, just assuming, oh, these are just numbers, I won't learn about it. Having a general idea can potentially stop you from getting an option contract where the theta is 75 cents a day, which is $75 a day. Well, don't get that option. Okay. Um, Treating options like shares is another way or reason why options traders will lose money, thinking that, oh, well, I know the price is going to go up, so I'm just going to get a call option right here, and as long as the price goes up, it's fine. No, you have to get a specific type of call option. You got to make sure the strike price is right. You got to make sure that the expiration date is far away. You got to make sure that it's, at the money or not too far out the money, because all of that's going to be baked into your profit and loss. So options work best when you already understand price action. And they work even better when you know the direction plus the timing. It's one thing to be right on the direction, but your timing has to be right with options. And so that's why, because you guys know I trade all markets, and people ask me all the time, what should I start with? What should I start with? What should I start with? I say options should be the last thing that you try because you have to be right on so many things. You have to be right on the type of contract you get. You have to be right on the direction of the underlying stock, and you have to be right on the timing. That's a lot. That's a lot of being right. And if you trade, you wrong a lot. Well, so it's like with futures, you don't have to be right on the timing. You don't have to be right on the type of contract you get. You just have to be right on the direction. There's less you have to be right on. Does that make sense, y'all? That's like a really good way to explain it too. There's less factors. So options also work best when you accept the defined risk, which is essentially the premium. That is the good thing about options is that your risk is built in. You can only lose what you paid. Can't lose any more than that. So the price you paid, the worst case scenario is it goes to zero. That's the worst case scenario. You don't have to worry about the option eating into all your account and blowing your account unless you get an option that is literally the entire value of your account. But if you get options that are the value of your set stop loss or your set risk for the day, then okay, worst case scenario is this goes to zero, and that is my stop loss for the day. That is my defined risk for the day. The thing you don't want to do is spend your whole account on options. That's how you blow an account quickly. Do we have any questions so far?
Hey Jazz, hey ladies. So yes, I have a few questions, but I'm thinking on the top of my head for somebody who is trying to scale a small account, like $1,000 account, do you have any insight on whether there are better tickers that work well with a smaller account? I mean, at
Yeah.
the money, in the money. I know beginners probably shouldn't be trading out the money, but what are your thoughts on that?
Okay, so for small accounts, the best options to trade are going to be the small caps. Small caps are going to be the best options to trade because you can afford a quality option on those. There's two ways that small account traders try to trade options. The first way people go is, oh, I'll just get some out the money soon to expire options. because those are cheap and that's what I can afford. That is the riskiest way to try to grow a small account. Does it work? Yes, it can work, but it can also really, really, really not work because you got to be right on so many things. But that's how they grow accounts really, really fast is they get those cheap out the money QQQ, SPY, the big index funds, the ones that are super volatile, and usually it's index funds that are kind of representing the entire market movement, so you don't have to like be so individual stock um specific. So that's one option that a lot of people do, but this a better, more a way that's less risky is to trade closer to at the money small caps. So the small cap options are going to be cheaper because the underlying stock share is cheaper. So think of, as far as what type of small cap it should be, think of any stock that is trading under $50 a share. That would be a small cap. So some of my favorite small caps to trade are SoFi, and really get in on SoFi, y'all, because SoFi is not going to be a small cap for too much longer. Not too much longer. So SoFi, Lyft, Uber used to be a good one, but now Uber's expensive. And that's what happens. These small caps are small caps until they're not. But Lyft is still a good affordable one. Iron, that's one of my favorites. Iron is a really good small cap. And it doesn't need to just be a small cap, but it needs to be a small cap that moves a lot during the day. So when you go and look at these charts, let me share my screen. And there's also things you can look up too, because people are researching this stuff all the time. What are volatile small caps? What are small caps with a high average daily range? You hear that word. Average daily range means the average dollar amount a stock moves in a day. The higher the average daily range, the better. Because a small cap that moves a lot, it's the best of both worlds. You're paying less for a quality option and you're making good money on those options because the stock is moving so much. So SoFi is a favorite of small account traders because it moves so much and the options are so cheap and you can get a quality option of it and they're inexpensive. Palantir was a great small cap stock that traders traded, but they traded it so much. Now Palantir is like over $100. So they traded it to the point where it's no longer a small cap. Um, and that's what eventually ends up happening. It may take a year or two, but that's what ends up happening. Let me show you the iron chart. Oh, and I've been looking at Microsoft, y'all. Microsoft is getting to a buy area. Just fill this gap back here from May, like literally right at the gap and then bounced. So anyone that is interested in a longer hold option, Microsoft is looking like the best buy of the month. Really, this is like perfect that it filled this gap like this. So let me pull up iron. Okay, this is iron. Small cap. The highest that it went was $76. Right now it's $41. Let me show you when I put it on the daily. You can look up the average daily range, or you can just like guesstimate the average daily range by looking at the daily candle. So this daily candle, iron moved from wick to wick from $36 to $44 in a day. That's almost an $8 movement in one day. That is a lot of movement for a small cap. And that's what you want to see. Anything over $5, anything with a daily candle more than $5 is a good small cap to trade because you can make a lot of money on those options with that type of movement. This candle, this daily candle, $44, $38, $6 move. Great. This $52, $43, $9 move. Let's see some of these smaller ones. A small candle where it didn't really do too much. Went from $50 to $53. So on the small end, you're looking at a $3 range. That's really good for a small cap. That's really, really good for a small cap. Let's look at SoFi. I can just tell off of looking at it that SoFi doesn't have the iron daily range, but it's still pretty good. Some of these bigger ones, 25 to 22, that's only $3. Iron's looking much, 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 much better. Look at this, y'all. This is the type of stuff that makes me kick myself. Look at what I put down here. Better long hold entry. It should say better hold long entry, but that's a note that I put to myself to when it gets to that level to buy. Look at what happened. If I would have, I wrote that in 2023. If I would have held that, one thing that I've learned about me as a trader, and this is not to like sound cocky or whatever, this is just based off of experiences. I'm a really good bottom caller. I have called so many bottoms, and with my trading journey, trusting yourself is like a big thing. And so I would like literally not trust myself, but I'd be right. I'm a really good bottom caller. Some people are really good top callers. I'm not a good top caller. I know my strengths and weaknesses. I'm not a good top caller. But I'd be thinking these and just keep going up. But I'm a really good bottom caller. Anyways, that's a side note. So yeah, looking at the daily candle and look at the daily range. Anything $5, fantastic. Let's look at Lyft. Because the thing about Lyft is look at where it's been. It used to trade at the $65 range, and it's slowly but surely doing its thing. But when you look at some of these small caps, you got to look at some of their bigger competitors. So Uber, when we look at Uber charts, so keep this in mind, it's kind of consolidating, but it's kind of in a range a little bit. Somewhat, right? When you look at the competitors that are larger than them, it can kind of give you an idea of not only where it can go, but how fast they can get there. Uber is looking like a good buy zone right now. Yeah, Uber is looking like a really good buy zone. Okay, I can get distracted with these charts. Yeah. Uber used to be a small cap, but then they ran it up. They ran it up. Let me actually see what Palantir is at. That used to be like the OG small cap until they ran it up. Yeah, right now, I would say iron is a really, really good one. I've been looking at that every day. But just in general, like these AI computing semiconductor small caps are going to be very, very small account friendly for the options because that's the type of market that we're in. Every industry has its time to shine. Right now, it's AI's time to shine. So anything related to AI, computing, cloud computing, anything that has any companies that are really big on like holding data storage for all these companies, really, really good. Like QBTS is another one. Quantum computing, anything with the word quantum in it. You want to look at these things, right? So this is being traded a lot, which is good because it has a high average daily range. This is a good one too, and it's a small cap. Right now it's at $20 per share, which means that the options are cheap. You can get an at-the-money one for inexpensive. Right now it's retesting a broken support, so this looks like a downtrend, but it doesn't matter. You make money both ways. As far as its daily range, one candle, 17.20, that's $3. 16.7, 19.7, that's $3. So $3 daily range, that's really good, especially for a $20 stock. Because again, we were talking about delta. If you have an option that has a delta of 40 cents, which is $40, every dollar that the stock moves, the option moves $40. Another, let me go to my watch list to pull up some of these computing ones that I have on there. Oh, RGTI is a good one. Computing. Same thing. Oh, it broke its support also. $17. But look at some of these daily candles. 44, 38. On average, you're kind of looking at this area here, 26, 24, $2. That's not terrible for a $17 stock. Riot. Oh yeah, I used to love Riot. Because they were saying Riot was going to be the new Tesla for a long time. I was about to say, yeah, I remember Riot when it was at these prices back here. So wow, it's come down a lot, but it's ranging. It's been ranging for the last few years. Okay, yeah, these daily candles look really good though. That means that it's getting a lot of trading volume. So it may not be going anywhere. It's not trending, but it's trading. And that's good for you as a trader. But this is a terrible chart for a stock share trader because it's not going anywhere. But as far as like trading, yeah, people are in and out of this every day. It looks like these daily candles look really good for a $14 stock. Yeah, really good. 11 to 4, that's a $3 move on a $14 stock. These options, I mean, I don't know. Let's just take a quick look at how much a Riot at the money option is right now. Yeah, I mean, yeah, I don't know if you guys can see this. I can't see myself on the screen. But just the last trading day, Friday, Riot moved 20%. That's huge for a daily move. And it's a 100% buy rating on Robinhood, which is very rare to find a 100% buy. That's a good call. Who put that in the chat? That Riot's a good one. Yeah, that's a good call, Crystal. Riot. Okay, so at the money, slightly in the money, because the share price right now, it closed on Friday at 14.48. So slightly in the money would be $14 even. A $14 call is $111. Oh my goodness. Can you guys see this? Hold on. How can you guys see this? Is it backwards? Can y'all see this number right here? This is the at the money call.
Yeah, I can see it.
It
It's not
went
bad.
up 271%.
Wow.
So yeah, that's the way to go when you're doing small account trading. At the money, small cap stocks that have a big average daily range. Don't do the small cap stocks that aren't going nowhere because the option's just gonna lose money. So yeah.
Jazz, what about in the money? If you can afford
Yeah,
the is it the premium? Is it a good idea to do in the money?
absolutely. I used to only do in the money. I used to do in the money 3 months out, nothing less. But it's expensive. And it'll eat a lot of your capital. I'm talking like each option is like $5,000, $6,000 each. And so it gets to a point where it's like, dang, why am I spending so much on one contract when I would literally, I've kind of always been see profit, take profit. So I would literally close out that option when I was 20% up. But 20% of a $5,000 option is $1,000. So, 20% is good on a expensive option. But it's like I'm not even holding it for that long. I'm not making a huge percentage return. Let me just free up some capital to buy some cheaper options, but those have the cons. But yeah, if you're going to go in the money, the further out the better. Because you're going to be so mad if you get an in the money contract on something that expires soon and you lose so much on it and you paid way more than you needed to.
Okay, thanks.
And then also too with the in the monies, if you're gonna hold them, make sure like we just looked at the riot chart and how it's like it's being traded a lot on the day, but when you look at the chart, it's not going anywhere. So when you're holding options, you need to make sure that it's a trending stock. So ETFs are going to be really good. I'll tell you right now, if you can afford in the money option, the best option right now that's pretty low risk pretty low risk. There's risk, but pretty low risk is going to be IWM, which is the ETF that combines all of the small stocks, small cap stocks. Small cap stocks are really taking off and it's projected to take off even more in the future because that's going to be what people can afford. So, getting an ETF that combines all of the small cap stock movement is IWM, which is a extremely trending upward chart. Let me show you guys. IWM sometimes just looks like it's just going straight up in a vertical line. So this is IWM. Ever since the tariff drop, it's just been taking off because small caps are getting more and more volume coming in with investors, not only adding small caps to the portfolio, but a lot of people can't afford $700 SPX or not even SPX. SPX is $7,000. A lot of people can't afford $700 um SPY stocks anymore, stock shares. So they're moving over to small caps. So that's why you see IWM just going crazy. And right now it's currently at $265. Geez, it bounced off of this support so well. And I was not really trading on Friday. But yeah, that's a good one. That's a good in the money one to get. The best bet with the in the monies are going to be ones that you're going to feel comfortable holding, and those are going to be the ETFs. Any other questions, y'all?
I did want to say, like you were saying, IWM is good. I did trade them Friday, and I traded them twice. One of them was a 38% increase, and another one was 106. But crazy thing is, if I would have held that one even longer, because it was an in the money call, both of them actually was. Um, the first one I bought was 264,
Mm-hmm.
and then my dumb self got out, and then I re-got in because I was like, wait, it's doing what I wanted to do. And then I ended up getting a 265 call, ended up still getting out because I didn't trust myself. And I only bought one contract, and I sold it for let me see. I originally only bought it for 16 one contract. It was $16. I sold it when I sold it, it was $33. But if I would have held it, it's now worth $1.34.
Wow.
So
That's a
trust me,
crazy percentage.
right?
What's the expiration date?
Oh, it was the same day. It was the same
Okay, yeah.
day expiration. But with them, I believe they only do same day expiration. Well, what is Monday night? Yeah, they only really do same day expiration for all of theirs. And 1 day contracts unless you buy further out. You can buy, of course, buy a Tuesday contract on Monday, but of course, like you said, it's going to be paying more for that. But
Hmm.
this was something I was just swinging. I didn't plan on holding it for a long period of time. I was just doing it because I saw the movement for the day. So it didn't bother me that it expired that day because I knew I was going to make money off of it.
Yeah, with the soon to expire options, you have to make sure that you are okay with selling that thing that day, no matter what. You just gotta be okay with it. And so that's what I'm saying. The worst case scenario is it goes to zero. Best case scenario is you make a little money off of it. So only buy the options that you're willing to lose. $16 is not a big investment. And then if, like you said, if you would have held it, that $16 would turn to $100 by the end of the day. Um, IWM also moved 7% on Friday. Usually doesn't move 7%. Usually moves like 2 to 3% a day. So that was a really, really trending day. But yeah, those things, those times happen. They definitely happen. And I enjoy like adding things to my watch list and just like watching it and seeing, okay, this is moving like this, moving like that. And you just kind of get you kind of know like what to buy and what to look for. People ask me about the strike price all the time. Like, what strike price should I get? You got in the money. You can never go wrong with in the money or out the money. But if you're gonna go a little out the money, I say make your strike price your target price. So if you think IWM is getting to 270 by the time that you plan on selling it, then get a 270 strike price. If you think that whatever you think the price is going to get to, that's as far out the money as I would go. Your target price should be like as far out the money as you should go. Can you make money on options that are further than that? Yes, you can. But it gets more and more risky. It has to be like a surprise to the contract also too, because these contracts, they're starting to bake in a lot of things with the IV and everything. They're starting to bake in a lot of volatility. Like you'll also see same option contracts, they'll increase for buyers. If we're getting close to CPI reports, PPI reports, you'll see them increase because they know um, a lot of times these CPI and PPI things are making the stocks shoot up. And so they bake that in there. So you can't make too much off of that. Any other questions, y'all? The craziest out the money option play that I had this year was gold, weekend hold. Bought the contract for $19 on Friday. Monday morning, the contract was $462. Crazy. but gold also, it had moved like $17 over the weekend. You know how gold's been moving lately. Now that gold's doing what it's doing, a lot of these new gold contracts have that IB built in. So I probably would never be able to make that return again because now it's baked in. But this was in December or the first week of January, one of those. So it wasn't baked in then. So yeah, you'll notice that as well, that they switch up the rules a lot in options. And they'll be like, hold on. All right, I will let everybody go. Perfect.
Thanks, Jazz. Have a good day, everybody.
No problem. Y'all have a good weekend, and I will see you guys in the market tomorrow.